Hey everybody, hope everyone's doing well. This is the Emini review for Monday, July 8th, 2024. And because it's Monday, we'll start with the weekly chart. And you can see the market's been in a bull trend. We've been rallying for many weeks. But at this point, the bulls have had 3 pushes up, and you can see we're testing a channel line. Only 25% of breakout attempts of channel lines actually succeed in breaking out and converting the trend into an even stronger trend to the upside. What typically happens is the market reverses within 5 bars and then tests the trend line, which might be here. And that's a 75% chance the market ends up reversing and coming down to here. Plus, we have an outside week last week and a bad buy signal bar the week before this bear doji. So I think at a minimum, the market's going to come back and try to test the high of this week. Since outside bars are trading range bars, they're expanding triangles. That reduces the probability for buying above it. If you're buying above the outside bull bar, you're basically buying the top of a trading range. Now for the daily chart coming into the day. Again, the market's been rallying, but you can see even on the daily chart, we have 1, 2, 3 pushes up. The market's rallying fairly strongly, but that could be a climactic end of the move. Now, we did have 3 consecutive bull trend bars on the daily chart, so the odds were we're not going to just reverse down and crash today. But I thought the expectation coming into the day was some sort of disappointment for the bulls. The bulls are getting a breakout attempt of this trading range. They have a small breakout here, then a bigger breakout here that's pretty decent, but now they need follow through, which is what today would end up being. I thought the odds favored disappointment because we have 3 pushes up in a tight trading range. So I thought at a minimum, the expectation coming into the day was sideways to down price action, starting by the start of the second hour of the day. That's what typically happens after a couple of trend days. And then for the 5-minute chart, we'll go bar by bar. So coming into the day, we had a bull trend on Friday, and then a gap up today, and a big bull bar on the open. So it looks like the market is accepting the gap up. So we have a gap up and then a follow-through bar. You can think of gaps as trend bars. So from the close of 81 to the open of the day, that gap can be seen as a white bull trend bar, and then bar 1 could be follow-through. Bar 1, fairly big bar and fairly big tails, but a decent bar for the bulls. But what we don't know at this point, if you look at yesterday or Friday, whenever I say yesterday, I'm referring to the prior trading day. Bar 78 is an outside bar. So here, we rallied, we sold off, we rallied. This might be some sort of expanding triangle. I know the shape isn't great, but they operate the same way. This is a bull breakout, but I think we still need more follow-through for the bulls. So as far as buying above bar 1, I'm not sure if there's enough information, especially considering the fact that we're expecting a pullback. And I'll just draw yesterday's high as well. And then bar 2, inside bear bar. It's not what the bulls wanted to see, but it's also not very strong for the bears. It's an inside bar, so that's not all that high probability. The odds are if the sell triggers, it will fail. But it's also a bad buy signal bar. It's probably sellers above bar 2, scaling in higher above bar 1. But bar 1 was strong enough for a second leg up, especially when you consider the gap up. This is all one leg. And then you can see on bar 3, we triggered the sell below bar 2, and then immediately reversed up. Bar 3 is a bull reversal bar closing on its high. Bears will exit above 3. Bulls will buy the high 1, expecting a second leg up. So we're probably not done with the upside. And then bar 4, we have a bull bar, which broke out to a new high above bar 1, but then failed to close there. So it's a breakout bar, but did not close at a new high. So it could be stronger for the bulls. But what about selling below bar 4? It's a double top with bar 1. One of the problems is that it's a bull bar. It's not a very strong signal bar. The odds are there are more buyers below bar 4, at least for a scalp. But as far as buying above 4, also not ideal because there were sellers into the close of bar 4, sellers into the close of bar 1 around the same price. So this area might be resistance where bulls are taking profits, and bears might start selling above bar 4 or at some distance above bar 4. And then bar 5, another disappointing bar for the bulls. So at this point we have 2 legs up, 1 pullback, 2, and look at the second leg. We rallied, pulled back, rallied, pulled back, rallied, pulled back again. That's a micro wedge. There's 3 pushes up on a smaller time frame from bars 3 to 5, and it's 2 legs up on this time frame. That increases the chances that the market will correct and go lower. So even though 5 isn't a very strong signal bar, bulls might exit below it. It's not a very good place to buy below, context-wise, even though it's not a very strong sell signal bar. Some bears will take the sell below 5, hoping for a strong signal bar, or a strong entry bar, rather. I also want to say one more thing. At this point, let's look at one more bar, about 10 o'clock. So you can see bar 6, we triggered the sell below 5. It's a weak sell. Bulls who bought below 5. If you bought the low of bar 5, and bar 6 is your entry bar, it's not all that good. It's not a bear bar, but you're hardly at a profit. And now bar 6 is a high 1 at resistance. And there's usually more sellers above high 1s, and we already have evidence of selling pressure in this area. And if we trigger above bar 6, that will technically be a third leg up. Leg 1, leg 2, pullback, and then leg 3. So that increases the chances that there are sellers above bar 6. And the point I want to make is the Globex chart coming into the day. So now we've seen up to 10 o'clock. Let's look at the 15-minute chart and think about the context. So here's 10 o'clock. Here's where we can see on the 5-minute right now. We can see the market rallied, but this is not a very strong rally. It looks more like a bull leg in a trading range. And then the market went sideways for many bars here. Remember, this is the 15-minute chart. It went sideways for a lot of bars. And look at where the market is. It's at a measured move of this trading range. So that's another reason there might be resistance. Remember that rallies on the open, there's a 50% chance, no matter how strong they look, that they're going to reverse, and they might even lead to a measured move in the opposite direction. But we already know on this day, up to 10 o'clock, that this is not a very strong rally. There's problems with it. It's 2 or 3 legs up, selling pressure, bull bars with big tails above. Context isn't very good. And then 7, there were bears looking to sell above the high 1 on bar 6, but did not get triggered. And eventually, there's a sense of urgency, and they pull their limit orders to sell lower, and then they start chasing the market. 7, now that's the high 1 signal bar, but it's not a strong signal bar. Obviously, it's a bear bar. There's probably more sellers above. If you think about I apologize for my voice. I'm still getting over this cold. If you think about what bar 7 did, it's a bear breakout. It broke out below the low of bar 6 and a couple of other bars to the left. If a bull bought below bar 6, they're disappointed with their entry bar, and they'll probably look to use bar 8 to exit at break even if they get the chance. So bar 7, big enough breakout for a second leg to the downside. We've had a couple legs up. This looks like an overall trading range open. We'll probably get a couple legs down. Also, keep in mind that bar 1 remains the low of the day only about 20% of the time, so the odds are we're falling below bar 1 at a minimum. And if we do get there, we have yesterday's high, that magnet, very close. We'll probably get there too. Bar 8, an inside bear bar. Look at the high of bar 8. The market sold off on 7, pulled back, and then rallied a little on 8. Bulls who bought the low of 6 got trapped, scaled in lower. They used bar 8 to exit, and now bar 8 is closing a bear bar. There's probably more sellers below bar 8. It looks like bulls just got trapped and used bar 8 as a gift to exit their losing positions at break even. Also, bar 8's an inside bar. It's a bad stop order above. There's probably sellers above. And the bears are still expected to get a second leg down, so I would not buy below bar 8. Outside up on bar 9, it's a good-looking bull bar, closing on its high. But if you think about what happened on bar 6 and then the bear breakout, the odds are after bar 7, there are sellers above. Even though this was an inside bar, it makes sense that bar 9 went outside up. But outside bars are trading range bars. So if you're buying bar 9, it's like I said with, I forget, it was the weekly chart. If you're buying above an outside bar, you're effectively buying the top of a trading range, and that's never ideal. So there's probably more sellers above 9 for a couple of reasons, as strong as the bar looks. And then 10, instead everybody stole the close of 9. We did not get above it. 10's a strong bear bar. You can argue it's 2 legs down, but it's a strong enough bar. It's probably going at least a little bit lower. And like I said, the bar 1 low is a pretty obvious magnet. Just before it, another magnet is the moving average. We'll probably test there as well. And then follow through on bar 11. It's basically the minimum follow through. It's a bear bar. The bears prevented a bull close, but it did close above its midpoint. So even though bar 11 was the bare minimum follow through, think about the context for the bulls. The bulls might be able to make an argument here. We have 2 legs down, so 1, pull back, 2 legs, and then a rally into the close of 11. It's a lower low double bottom with bar 1 testing the high of yesterday. So what about buying above bar 11? Well, there's a couple problems. It is a double bottom, but this momentum down on bars 10 and 11 is strong enough that there's probably going to be a second leg to the downside. And bar 11's a weak buy signal bar. Bulls would rather buy above a bar like bar 3 or bar 9, not a weak bar like 11. So for a couple of reasons, there's probably more sellers above 11. Bulls might look to buy lower, but this is not an ideal double bottom setup. Probably sellers above 11. And then 12, we triggered the stop order buy above 11 and had a disappointing entry bar. Any bull that did enter, taking a chance, quickly exited, and 12 became a doji. Bar 12 really did not improve the context or the strength of the buy for the bulls. So still probably going at least a little bit lower. This was a pullback. So some traders will view this as 1, pullback, 2, pullback, maybe the start of a third leg down. So maybe there's buyers below bar 12. It's a low 1, possibly at the bottom of a trading range, maybe at support, the high of yesterday or Friday, and a low 1 with a weak signal bar. So there might be buyers below 12, but I still think the bears will get a second leg down. 13, a bear bar. It's a bear reversal bar closing below the moving average. The bulls have had 1 bull bar in 6 or 7, maybe 8 bars. So there's not enough buying pressure to be looking to buy. The bulls might be buying for scalps, but if you're looking for a double bottom reversal, the bulls aren't getting it. 11 wasn't a strong signal bar. 13 is not a strong signal bar. The bulls might be hoping 14 becomes a bar like 3 or 9, but bigger. But they're hoping. And this channel is, even though it has pullbacks, it's tight enough that this might be one leg on a higher time frame. And if that's true, this might all be leg 1, then we might get a more complex pullback and then a bigger second leg down. I'll draw another magnet, which was, we can call it the close of Friday, but another one might be here. I'll explain this one. The reason I'm using this line instead of the close is because we had consecutive bear bars, one being big, closing on its low, crossing the moving average on 79 on Friday. You had bears who sold that close and took a chance we were getting a bear breakout, and they got trapped, and then we got this gap up. So we have trapped bears at this price. So if the market does come down and test this light blue line, the odds are there's support here. We have trapped bears looking to exit their losing shorts if we get back down here. So that's another magnet. Bear breakout 14. Remember I said the bulls were hoping for a strong signal bar? Well, 14 is not that strong signal bar. 14 is very similar to 11. And what happened with 11? There were sellers above. You can argue it's slightly better than 11 because now we have 3 legs down. You can call it a wedge. 1, 2, 3 legs down. But again, it is a tight channel, so it's probably a parabolic wedge. And parabolic wedges are breakouts on higher time frames, and the reversals that come from them are expected to be minor. So you can think of the reversal after the wedge as a bear flag, and then expect another leg down. And when I say another leg down, I mean a leg similar in size from bar 7 down to bar 14, which is fairly big. Probably sellers above 14, not enough buying pressure to be buying. Inside bar 15, so 15 being an inside bar reduces the probability. There's probably buyers below and sellers above. But if you are buying below 15, you're just scalping. You're not buying below 15 expecting a bull trend. The buyers below 15 are expecting what I explained about the parabolic wedge, which is a minor reversal. You have exhausted bears, 3 sell climaxes down to 14, and then a low 1 short. At support, the high of Friday. So yeah, there's probably buyers below 15, but again, they are bulls that are scalping. And this is what Al talks about with, if you are counter trend scalping, it's okay to scalp counter trend. So in this case, to be looking to buy for scalps, but that's okay if it doesn't take away from your ability to enter in the with trend direction when you should be doing that. So what he's talking about is, if you're looking to scalp counter trend and then you're not able to get short for the bigger swing to the downside, then you should not be looking to counter trend scalp. You should just be focusing on looking to trade with the trend, which in this case is to the downside. We're probably always in short. This is a tight enough channel. I mentioned it's a breakout on a higher time frame. We're probably going lower. When did it become always in short? I think probably by bar 11. It's okay to be short. There's not that much of a risk of a rally above 11. We're probably going lower. And then it just got stronger for the bears down to 15. 16, we have another inside bar, so consecutive inside bars. It's breakout mode, probably buyers below 16. There might be sellers above for a scalp, but I think the bulls and the bears are expecting some kind of correction and a test of the top of the last sell climax, the high of bar 12. Outside bar on 17, so there were sellers above. We didn't technically go above 16, so 17 is a variation of an outside bar. They behave the same way. Sellers above, buyers below. It's a tight trading range, but again, we're still expecting some kind of rally, maybe a couple of legs up to test somewhere up here. 17 is a weak buy signal bar, but it is a reversal bar and a micro double bottom with 14. Some bulls might buy, taking a chance. And then buyers below 18, it's a double bottom with 14, and then a bull reversal bar closing on its high. Some bears will probably exit here, even though it's still probably always in short. 18 is a strong enough reversal setup. We'll probably go at least a little higher and get some kind of pullback. Bulls will buy for a scalp. And then a decent bar for the bulls on 19. You can see there were buyers above 18. It's also interesting, 18 being a double bottom. It's also a micro wedge. So on a smaller time frame, we sold off, rallied, sold off, rallied, sold off a third time, and rallied a third time. We got a bull bar closing on its high. So it's a wedge double bottom. A couple of reasons to expect support there. And like I said, bulls who are buying here are buying for scalps. So if you're buying, you can't trick yourself into thinking this is a swing setup. Now there is an argument to be made. Let me put it this way. Here's a tight bear channel. And what does Al say about reversals? You should not be looking for reversals until there's a strong break of the trend line and then a retest of the trend's extreme. And then you can look for a major trend reversal setup. So here, 18 and 19, the bulls are getting the break of the trend line. Here's the bear trend line. Here's the break of that trend line. That's good for the bulls, but this is still a minor reversal. So we know that bulls who are buying down here, they're buying the lows, maybe buying above 18. They're buying for scalps. We're expecting a test, maybe of the bar 12 high. And then we're expecting a retest of the bear trend's extreme. So what that means is we're expecting traders to be selling somewhere up here, which we had into the close of 19. And now we have 19 is a weak sell signal bar. There's probably buyers below 19. Inside bar on 20. It might be 2 legs up for the bulls. We rallied up to 19, pulled back, rallying again on 20. And 20 is a high 1 on a smaller time frame chart. It's an implied high 1, probably sellers above. Probably going to come back down and test somewhere around the high of Friday. And at that point, the bulls will be hoping for a major trend reversal. But the bulls need more buying pressure. They need better bars than 19, a big bull bar with a big tail above. This tight channel is still probably going to get a second leg down. 21, we have a bear bar, but it's a trading range bar. triggered the low one below 20, found buyers below. The market's in a fairly tight trading range here. Is this the double bottom? Maybe we rallied, pulled back. Are bulls buying above 21? I don't think so. I think 21, there's not enough bars in this pattern to be a major reversal. We've only been above the trend line for 3 bars. And 21's a weak buy signal bar. There's probably sellers above 21. '22, we fell a little bit lower. Now we have a retest of the trend's extreme. This is sufficient. But 22 is the same problem as 21. Not enough bars and a weak buy signal bar. There's probably sellers above 22. Also keep in mind that 60% of major trend reversal setups lead to trend continuation or trading ranges. Only 40% lead to major reversals. And then we rallied on 23. The problem with bar 23 is we might have a second leg trap in a trading range. Maybe we rallied up to 19, pulled back, rallied a second time to resistance. We know what happened the last time. The market was at the high of 23. We found sellers. Some traders will also view it as a wedge. We rallied on 14, pulled back, rallied 19, pulled back, and then rallied 23. It doesn't matter that the first push happened before the bear leg was over. It's really frequent. You see that all the time. So what the bears see is a wedge bear flag. They're looking to sell somewhere in this area for a bigger second leg down. I'm going to erase some of these lines because the chart's getting busy. So the problem for the bulls here, possible wedge bear flag. They're hoping for a major reversal, trend line break, retest of the lows, which I wouldn't consider. 22, the retest of the lows. I don't think there's enough bars. Maybe if we retest again and get a reversal setup, that could be the chance for the bulls. But we still need that. We need more bars in this pattern. Inside bar 24, probably sellers above. Weak buy setup and at resistance. And then 25 rallied a little, almost outside down, and then it closed a bear bar on its low. So think about for the bulls. This is a tight trading range and a possible final flag. Maybe the bears get one more breakout attempt. But the bulls need to see more buying pressure. They don't want to see a bear bar closing on its low like 25. And they want to see more bull bars in a decent, maybe a double bottom with 18. Some kind of reversal setup. Then a bear breakout 26. So how's that for a signal bar for the bulls? It's obviously not very good. The bulls can try to argue 3 pushes down. Technically it is 1, maybe 14, and then 26. But who wants to buy above 3 consecutive bear bars? It's a fairly strong breakout. And this is a weak signal bar. Now, I say it's a strong breakout, but it only broke out. It did not close below the lows of the prior bars. So it's not as strong as it could be. And the bulls can argue possible expanding triangle, final flag. So they need to see, let's see what bar 27 looks like. If it's a bull bar closing on its high, bears will probably exit and bulls can enter for a swing. And then 27 became a small inside bull bar. Not all that strong. There's probably sellers above 27. This breakout was strong enough for a second leg. Sellers above 27 for a second leg. Maybe buyers below for a scalp. But when the bulls and bears are expecting a second leg down, it's not ideal to be buying. Outside up 28, but it's possibly a test of the moving average. 25 broke out straight through and then got followed through. There's traders who bought the moving average that got trapped. If we retest it, they'll probably be disappointed with what happened here and look to exit, and that creates resistance. 28 is an outside bar, so it's a trading range bar, probably sellers above the trading range bar. It's also fairly clear that it's a trading range bar because it's basically a doji. And we came very close to testing the moving average on 29. It's a micro double top with the bar before it. Tight trading range for 3 or 4 bars here. The bulls are hoping for a final flag and a major reversal. But the reality is there's not enough buying pressure, and it's a fairly tight bear channel. 30 was a breakout bar, but became a doji. We broke out below 29 and then pulled back immediately. But is 30 a strong buy setup? Probably not. It's forcing me to buy on a stop above a trading range bar in a very tight trading range, just below resistance, moving average, and the high of Friday. It's probably sellers above 30. And then 31, we had a bear breakout. So the bulls that were hoping for this to be a trend line break, this was a trend line break, and then a retest of the lows and a major reversal, they're probably giving up with 31. 31 strong enough, probably going at least a little bit lower. Then 32, strong follow through. So consecutive bear bars closing on their low, very strong bars. But there's a problem with these bars. And the problem with these bars is how strong they are. Why is it that we're getting the 2 strongest bear bars of the entire sell-off after about 20 bars in the trend? That's a classic sign of an exhaustion gap. And so what this is probably the last of the weak bulls getting out of their longs and weak bears initiating shorts. Bears see this and they say, finally, it's very clear. It's strong consecutive bear bars. I'm going to get short. And Al says there's a 60% chance of a measured move down. But now we have to consider the context. Look at this line that I drew. We're testing exactly where bears got trapped on Friday. There's a more legitimate argument for 3 legs down, and then a sell climax to test the channel line. And remember what I said about channel lines. There's a 25% chance we have a successful bear breakout and acceleration of the bear trend. 75% chance we get a reversal within 5 bars and then rally and test the trend line. Is this a strong bear trend? It's really not. It's a bear channel with a lot of overlap. You can argue that there's a trading range for most of the channel. If I just showed you the bars in the green box, you would tell me that's a trading range. And so it's not a very strong bear trend. So that's the problem with these consecutive bars. It's aggressive, but it's more of a buy the close bar on 32. 33, we tried to break out below maybe the low of bar 81, some bars to the left. But then 33 became a bull trend bar at the channel line. And bears who are selling here are selling momentum, and they're hoping for a quick measured move down to here. But then you get bar 33. And when you get bar 33, you know the probability is no longer 60% that we're getting down here. It's probably less than 50%. So bears will give up on the trade. This was strong enough for a second leg down, but the second leg is probably going to be minor. And there's one more thing I want to see here. It's possible we had a leg 1, leg 2, measured move. So not quite. Maybe if you use bodies, I used the tails of bars from the high of 5 to the low of 14. You could put the second leg here or here. Here's the second leg. We came close. Maybe we'll go a little bit lower, but it's close to a second leg, a symmetrical second leg. We were expecting this to be a breakout on a higher time frame, and we had the second leg down. Now we have 3 pushes down, expecting maybe 10 bars and 2 legs sideways to up. And are we expecting this bear channel to last all day? Probably not. It's probably going to be some sort of trading range day. So we're probably going to start to go more sideways to up. So what about buying above 33? It's not ideal after these strong bear bars. The context is okay for it if you're betting. It's an exhaustion gap. We'll probably test the high of bar 31 or the high of 28.29, the last sell climax. There's probably buyers below 33. Inside bar 34, it's a low one at support. There's probably buyers below 34. Another sideways bar on 35. You can call it a micro double bottom. Tight trading range, possibly a final flag. Bears might start to give up. Remember, you have these bears who are short down here, hoping for that measured move. But the more it goes sideways and stalls, the more hesitation there is, the more worried the bears will get that we're not going down there. They were betting on momentum, and now the momentum to the downside is gone. Outside bar 36, testing this line once again. It's a reversal bar, even though it's a trading range bar. It's not ideal to buy above 36, but it is a second reversal. Some bulls will buy above 36, and what they need is a strong entry bar. 37, not a strong entry bar. We've gone sideways for 5 bars. It's possibly a final flag, tight trading range. You can call it a triangle. The range is contracting. It's not perfect, it never is, but it behaves all the same. Probably buyers below, probably going higher. 38, we have a bull breakout, but another trading range bar. It's not very strong, but the opposite side of the trade, selling below 38, is also not very strong. There's probably buyers below 38. 39, we had basically an outside bar, and 39 is the same problem as 38, and there's probably buyers below 39. It's a low too, but at support. The buyers may not come in right below 39. Maybe they'll buy somewhere around this support line. But the odds are there are buyers below 39. 40, we have an inside bull bar. Weak sell signal bar, probably buyers below. And think about what's been happening over the past 7 or 8 bars here. Bears sold, and then we're getting a pullback. And they're still looking for a second leg, still looking for it, but it's becoming a little bit of an endless pullback. And at some point, the bears might give up, and the bulls might buy, knowing that the bears are getting squeezed out. Consecutive bull bars, 41, but just below the moving average. Probably sellers at the moving average for some sort of second leg down. The reality is still that this was strong enough for a second leg. 36 may have been the minimum second leg. It tested the low close of 32. And if it continues to rally, we'll look back at it and say, yeah, there were 2 legs down. But there's probably going to be some sort of second leg that is bigger than 36. 42, we stalled at the moving average, where we're expecting sellers. There's some breakout points over here, like the bar 27 or 28 low. Bar 28 low, this bear breakout fell below the low of that bar, got follow through. Bulls buying below that bar, got trapped. We're testing it here. So if we rally back to that price, it acts as resistance, and we're also testing the bear trend line. Bear breakout 43 might be the start of the second leg down. after a pretty prolonged pullback. This was enough disappointment. There's probably buyers below 36, 33, somewhere below. And bears who sold the close here, if they didn't get out on 36, they're trapped. They're looking to get out on any sell-off as well. So this endless pullback became a breakout on a higher time frame and strong enough for its own second leg to the upside. And then an outside bar, 44. So that could be two legs down. We sold off on 43, rallied, and then sold off again on 44 with a lot of overlap. There's probably buyers below 44. Inside bar 45, it's a bull bar closing on its high. It's possible that now we have this rally and then a pullback and then maybe the start of a second leg up. Bull bar closing on its high. Some bears might exit above it. Bulls might start to look to buy. And then a second leg to the downside for the bears. It's kind of nested. So we have leg 1, pullback, leg 2, and then here, leg 1, leg 2. Outside bar 46. Not the strongest buy setup in the world, but the context isn't that bad. The signal bar itself is not strong, so the bulls buying above 46 want a strong entry bar. And instead we have a doji trading range bar. But now we have a low 1, maybe a low 2 short set up below 47 at the bear trend line, but the context is bad. There's probably buyers below 47. And then 48 bull breakout, closing on its high and breaking above the bear trend line. It's the first breakout bar. The bulls still want follow through. And then we got follow through 49. So bull breakout and follow through. Probably buyers below. And probably going at least a little bit higher. 50, another bull bar. It's probably by the close, always in long. Breaking out straight through the high of Friday. And we quickly tested the first target, which was the high of the last sell climax, 27 or 28, 29 highs, which was tested on bar 50. This breakout strong enough for a second leg, probably a measured move up as well. 51, finally getting some profit taking from the bulls. What happened? The risk becomes too much for the bulls. Buying up here, the stop's all the way down here. Bulls have to reduce their position size. That leads to a pullback. But 51's a low one after a strong spike. It's a bad short. There's probably buyers below 51. Think about the bears who are short anywhere down here. They're hoping for any pullback to get out of their losing positions. And bulls who didn't buy are looking to get long. So that's what produces the second leg to the upside after a shallow pullback. We triggered the low one on 52. Consecutive bear bars, not a very strong buy signal bar above 52. It's probably sellers above. Might be enough for a second leg to the downside, but it's minor. Keep in mind, the always in direction is now long, and we're probably getting a measured move up to here. Bull reversal bar 53. Some traders might view it as a wedge bull flag. 1, 2, 3 pushes down. It's more clear on a lower time frame chart. It's implied on this chart. But a bull bar closing on its high. After a strong breakout, there might be buyers above 53 and scaling in lower. 54, good entry bar, not climactic. Bull trend bar closing on its high, probably going higher. And then pulled back on 55 for a second leg. Leg 1, pullback. Leg 2. Remember I said if you're buying above 53, you're also scaling in lower. So a stop below 53 is a skunk stop. So what happens on 55? Anyone who had a stop here, their stop gets run, only for the market to reverse up. It happens all the time. Micro double bottom 56. So now we have a nested 2 legs down, leg 1, leg 2, leg 1, leg 2. Not a very strong buy signal bar 56, but a two-legged pullback after a strong breakout to the moving average, probably buyers in this area for a second leg up. And then an inside doji, 57, consecutive inside bars, breakout mode, probably buyers below, and probably buyers above, looking for a bull breakout of a bull flag and a second leg up. 58, bull bar closing on its high after two legs down. It's a problem for the bears. Bears are exiting above 58. Bulls will buy. Consecutive bull bars closing on their highs. Good for the bulls on 59, probably going at least a little bit higher. 60, rallying some more. Small bars and not climactic. That's good for the bulls. And here's a target, a measured move of the bull breakout. It also would be in the area of the bar 9 low, where bulls who got trapped buying there would be able to avoid a loss as well. One of the risks that the bulls face is that this breakout was a second leg. Remember I said this endless pullback was strong enough to be a breakout on a higher time frame chart. So this might have been leg 1, and we pulled back and then got a second leg. And then this rally could be a third leg. And remember, one of the most important things in trading is to be aware of leg counting and avoiding leg 3, because leg 3 often pulls back deeply, if not reverses. So that is the risk of being long here. It's good for the bulls that these bars are not climactic, but the tail on 59 indicates a pullback. We rallied on 58, pulled back, and then rallied again on 59, 60. So it might be 2 legs up on a lower time frame and maybe 3 legs up. 61 is a major disappointment bar for the bulls. Bulls who bought below 60, they're trapped on 61. The market's been sideways for probably more than 10 bars, and breakout direction might be 50-50. It is an overall trading range day. And then 62 follow through, so bear breakout and follow through. And 62 is a weak buy signal bar. It's probably sellers above 62. And then 63. 63 is a surprise bar. It quickly sold off, testing low in the range, and I kept this bear trend line drawn, and you can see it's coming down close to that trend line. And then 64 penetrated the trend line and then reversed up. It's a bull bar closing on its high. So decent bear breakout, but context not very good. It's possibly leg 1, pullback, leg 2 trap, low in a trading range. And then you get a bull bar, 64, closing on its high. I think if you're a bear, you have to get out above 64. Even though it's not the most credible buy, it's pretty aggressive to buy above 64, but I would get out of shorts above 64. And then follow through. We have a decent entry bar on 65. I might have said 65 here. Probably buyers below 65. And then 66, another bull bar. Endless pullback, bear breakout, and then endless pullback. Probably buyers below. This is strong enough for a second leg up. Low 1 triggered on 67, but it's weak. And there's probably buyers below, scaling in lower. Bad high 1 above 67, probably sellers above. Trading range bar 68, sellers above and buyers below. And then outside bar 69, going very sideways here. Big down, big up, big confusion, going sideways. Market's in a trading range. Bear breakout attempt 70, but failed to close below. And 70 is a bad buy signal bar. It's probably sellers above. And then we rallied above 70, found sellers above. It might be a low 1, below 71, but bad context, buyers below. And it's a trading range bar. 72, bear breakout, but possibly 3 legs down. Not ideal to be selling down here. You're also testing an area where bears got trapped. Bear breakout, reversal, and then a wedge down to support. Probably buyers in this area. Low 1 inside bar 73, probably buyers below. Then we rallied on 74. The tail on 74 is a bull breakout that pulled back, or you can say it failed. But either way, there was a rally, and that broke a trend line. It also broke above the prior bar's high. Probably buyers below 74. And then we rallied on 75. This is a classic example of a major trend reversal, but it's sort of a nested pattern. So we have this bear breakout and then this rally. This rally broke the bear trend line. Then we have a retest of the trend's extreme, which I drew here. And then consecutive sell climaxes down to it, and then the rally. But this was nested in here too. I want to actually pull it up. Be cool to see. This is basically the end of the day. So here it is here. Bear breakout, trendline break, and then we need a retest before a major reversal. This was also probably a parabolic wedge. Not perfect, but maybe 1, 2, 3. And then that rally, strong enough for a second leg, but would probably get a deep pullback, test the trend's extreme, which we did. And then we could see it on the 5-minute, but it's more clear here that it's 1, 2, 3 pushes down. And then this is that bar with the tail. It's not as good as I thought it was, but if you're drawing it from here, here's this tight bear channel, and then here's that trendline break, and then the retest, and then the rally. So on an even smaller time frame chart, we have a 15-second chart. I'm not going to go down to it. It becomes pretty extreme, but it's the fractal nature of price action. It's pretty fascinating how it all behaves the same. Tight bear trend, trendline break, retest of the trend's extreme, and then a rally. Disappointing bar on 76. Disappointment is the hallmark of trading ranges. Big trend bar 75, probably going to get a second leg up. And then rallied on 77, but testing near resistance. Remember, bulls who bought below 60 got trapped, and that's where we're testing, so probably resistance in this area. Outside bar 78, we sold off on 78 and then rallied, but it failed to break out to the upside. I had to pause there, and I forget exactly where I was, but bar like 78, it's attempting to break out above all these bars to the left, but this is an overall trading range. This is an area where it's better to be looking to take profits if you're long. And it's 3 pushes up, 75, pulled back, 77, pulled back, and then 78. 3 pushes up to the top of a trading range. Better to be looking to take profits, but this is tight enough that it's pretty aggressive to be looking to sell. High 1 above 79, but probably sellers above. Good entry bar for the bulls on 80, but context still not very good. This rally has problems with it. There's a lot of overlap, a couple of dojis, bars with big tails, and the context isn't very good. Might be a second leg trap, and just so late in the day, not worth doing much of anything. And then we fell below 80, bad low 1, buyers below, and went sideways into the close. For always in today, I mentioned earlier, I thought we were always in short by bar 11, and it can be kind of confusing with the context, where always in with context, I thought it was probably always in long on the close of 32, certainly by 33. The reason for that is what I mentioned earlier. Consecutive sell climaxes And then the two biggest, strongest bear bars of the entire channel. That is classic exhaustion gap behavior. And also testing support, you're expecting a bounce. So even though you don't have the bull bars, the classic consecutive bull bars closing on their highs to make it always in long, I think the context was always in long on 32, 33. And then two legs up. This was strong enough for a second leg, but this was fairly disappointing. And then 61 might have been a little bit of a surprise, but I think after you get 61, 62, bulls have to get out. It's not doing what it should be doing. This big bar 63 doesn't make it always in short necessarily. I think what it is, it's a trading range day. So I always say, rather than think in terms of always in on trading range days, think buy low, sell high, and scalp. Because always in is for trending environments and swing trading. And in trading range environments, traders are scalping and they're buying low and selling high. So you get these big bars down, it's time to look to buy. Big bars up, look to sell. For stop order trades today, maybe you can buy above bar 3 for a second leg up. It's a high 1, bull bar closing on its high. After the gap up in bar 1, strong enough for a second leg. And then maybe you sell below bar 10, bear bar closing on its low, but it's not, it'd be a problem if it was lower in the range, but because there was room to the downside, you can sell there, at least for a scalp. And then I thought the next best stop order trade, maybe you buy above 18 for a scalp, maybe sell below 24 or 25, seeing it as a low 2 or low 3 in the bear channel, expecting a bigger second leg down. And then maybe you buy above 35. It's not really ideal. There's not a great stop order trade in here. 48 you could buy above, buy the close 49.50. Disappointed here. You look to get out on the retest. And that's where bar 60 actually tested to the tick, the high close of 50. And then maybe you sell below 61. I mentioned the buy above 64. It was aggressive, but okay. And then not a great stop order signal bar 74, but the context made sense to buy. And then maybe you buy above 77. There's some room to the upside, but not great. And for limit order trades, it's a trading range day, so there's a lot of them. You could probably sell above bar 1, buy below bar 2. It's a bad reversal. It's an inside bar after a big bull bar. There were buyers below 5 for a scalp, but disappointing entry bar. They got out. Consecutive bear bars, strong enough down for a second leg. There's sellers above bar 8. I mentioned this one. It's a bad double bottom, strong enough to the downside. Probably sellers above 11. Sellers above any of these bars, but we ended up getting that deeper two-legged pullback after the parabolic wedge. But sellers above all these bars for a second leg down. Bulls buy below 20. Strong enough up for a second leg, and they got it on 23. Strong enough down here to 26. Sellers above, inside bar, sellers above 27. And then, I don't know, it's aggressive. You can buy below 32, taking a chance, but always easier to see that and think about doing it after the fact. Tight trading range, bad low 135, buyers below, bad low ones all the way up. They didn't trigger below. And then by the time we got 42, it was a lot of legs up to the moving average, probably going to get a second leg down. And then we did, probably buyers below 45. Buyers below 50, but maybe not right below. And then enough down for a second leg, maybe sellers above 53. Maybe buyers below 60, but then bad entry bar, the bulls just give up. And then buyers below the low of the day, trading range. and that got triggered on 64. And then 3 bars up, buyers below 66, but we can get a deep pullback and test the 63 close, which we almost did. And then doji, sellers above, expecting more to the downside. Bad buy setup 70, sellers above 73, but now getting more dangerous in this buy zone. And that's about it for limit order trades. You can buy below bar 80, but late in the day, not worth it. Where do we go tomorrow? We have this rally on the daily chart and then a disappointing bar for the bulls. So what we might do is start to pull back, maybe toward the moving average and breakout points. I don't think that means we're going to get there tomorrow, but I do think the bulls are disappointed. There's probably sellers above today's high, and there might be buyers below. Sorry, I had to pause there again. I forget where I was exactly. But there's probably sellers above today's high, and maybe buyers below. This is probably strong enough for a second leg, but we can get a deeper pullback. There might not be buyers directly below. It's a trading range bar, far above the moving average. And as always, please feel free to leave questions in the comments and include timestamps for any question specific to this video. All right. Hope everyone has a good rest of their night. Thanks for watching.